it isn't just that this next derivative implosion or explosion, take your pick, either way, is going to affect just one little area. It's like a stick of dynamite where the fuse is already lit and it will take everything down in its path.
So my understanding of bank interest, like what they pay you for your deposits, is like it's like they pay you a dividend of what they make while gambling with your money through derivatives. Is that correct?
No, that is absolutely not correct. The interest that the banks pay you is because what you're actually doing is loaning them that money. This is what justifies it. In 2008, and anybody watching this that was around at that point, you might have noticed right after 2008, all of a sudden on your checking accounts, you would get some interest. It was only a penny, it was nothing. And you probably didn't even notice it, but what that did was legally, even the money, it's certainly true on your savings deposits, but the money that you loaned them in your checking account, well, now they're paying you interest on it. So that's how they get to use your equity for their benefit, because you are loaning the bank that money, they're paying you interest on that money, right? Because it's really a debt.
So like without admitting that it is like a loan, they're paying you back because it is technically a loan.
Well, they're not paying you back. They're paying you interest on the principal that you deposited in there. That's all. They're paying you interest on the principal that you loaned them. It doesn't matter whether you perceive that or not. That's legally, that's. But
they're not getting, with whatever they're gambling with our money, they're not getting pennies on the dollar.
Oh no, they make most of their revenue from trading these derivatives, which is, and remember, a derivative is just a big leveraged bet, and it's leveraged by nature because there's nothing underneath it. They can make a bet against stocks or bonds or weather or other derivatives or any combination thereof, and you have to understand that it's typically between 2, maybe 3 entities, which means you have no broad base of buyer, right? So when things go south, it's a problem. There's all of these legacy, they're called legacy derivatives that they created prior to 2008 were all unique. So there was absolutely zero market for them. And guess what? They're still floating out there, waiting to explode. And as long as the base fee, the cost of the contract is paid, they can keep those things floating indefinitely. So it isn't just that this next derivative implosion or explosion, take your pick, either way, is going to affect just one little area. It'll be like it's like a stick of dynamite where the fuse is already lit and it will take everything down in its path. There is going to be no place that's safe except for, frankly, physical gold and silver and your ability to create that food, water, energy security, barterability, wealth preservation, community, and shelter. That's why it's so important to get it prepared. Because the notional value just in the FDIC insured banks, presuming the accuracy of that 88.4 netting benefit that they're telling us about, is almost $7 quadrillion. $7 quadrillion that they're admitting to. That doesn't have anything to do with the value underneath. How do you print that? How do you bail that out? Wouldn't that be hyperinflation if you attempted to do that?
So let me ask you then, in the theory of banking that's mentioned in The Creature from Jekyll Island, the guy says, well, what if, in this hypothetical conversation they had, what if everyone goes to pull their money out? Like the bank doesn't have actually the deposits to pay all of the depositors.
The banks don't carry any reserves, and they really have a very minimal level of cash that's available. So you might recall in 2020 where all the banks, when people were there were runs on the banks that were happening, right? So there was a whole list of central bankers. It was like their little central bank show that trotted out and said, oh, you don't have to worry about it. We'll just print more.
Your ATM is safe. Your banks are safe. There's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve.
I mean, and that's exactly what they did. And during that period of time, if you went in and you got a little chunk of cash, maybe you got like $1,000 in 20s or something like that, there were so many bills. They were brand new bills. They were all sequenced in order because they just printed so much money to try and stop the run, stop the panic. And they have to do that because they don't have barely any money in the DIF fund, the Deposit Insurance Fund. There's no money there. So if one bank fails, they can cover it. If another bank fails, they can cover it. But if a whole bunch of banks fail at once, if there is a run on the banks, they have to prevent that, frankly, at all cost. Because a run on the bank would reveal that they really have no money, that it's just a big fat lie, that FDIC insurance is bogus, right? FDIC insurance was created in 1933 after the bank runs of 1929. Duh. Oh, it's insured. I'm in good shape. Well, guess what? It's a contract, and any contract is only as good as the counterparty, that other entity on that side of the contract. And you know who's on the other side of this contract? The Federal Reserve and the government. And what is their answer every time? Devaluation. Devaluation. Yeah, that's a crappy counterparty to have. You want to know what runs no counterparty risk? This. And according to the Bank for International Settlements, gold is the only financial asset, not one of two, not one of five, the only financial asset that runs zero counterparty risk. When we're in this kind of environment where, we're watching this whole system, I'm watching this system fall apart. We're at the end of this current experiment, this debt money experiment. We're at the end of its life cycle. It's why Bitcoin and the cryptocurrencies, have a shot at being in play. Because when there's no more purchasing power left in the currency, you must attack principal. But what do? They want you in the system because then there's not anything that you can do about it. Nothing, nothing, nothing. Stocks were created, the markets were created to make up for that difference in inflation. So those that had wealth could get wealthier and, in theory anyway, maintain your ability to purchase the same goods and services over time, et cetera, et cetera. But you're trying to do this in a devaluing asset, which is kind of like having a sink full of water and you've opened the drain so the water's going in and you're trying to scoop it with your hands and it's going through your fingers. That's why you have to have sound money with the broadest base of buyer, because everybody's going to be impacted by this. Everybody. There's just no way around it. The choice is, how do you want to be impacted by it? Because if you don't have physical gold and silver and that community around you to create surety in all of those mantra areas, then you have a very challenging standard of living. And the first part of the goal of the whole sound money strategy is to sustain as much as possible a reasonable standard of living. It's not rocket science. It's just historic fact and repetition. So we know what to do to protect ourselves from this. It's simple. And thank goodness it's not illegal like it was in 1964. You couldn't own more than 5 ounces of gold other than that way. That was it. Pre-1933 coins, my uncle had at least 3,000 of them. That's a very important lesson. And I think it's one that will do us all very, very well moving into the future.